This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. So when I first started doing this podcast, there were not a lot of trading podcasts. I might have been the only one. I'm not sure. Going back to 2012. My guest today, Niels Kaastrup-Larsen. He runs a little website, a little podcast. Little is not a fair word. I'm being a little bit derogatory. That's not fair. I'm just saying it because it sounds kind of fun. But he runs a little podcast called Traders Unplugged that happens to feature many of the traders that have been featured across my books over the years. You name it, been there. Jerry Parker, David Harding, Martin Luke, Alex Gracerman, Richard Dennis, the who's who of trend following pioneers and trend following excellence. His side gig, Niels' side gig, he is with DUNN Capital in Europe. DUNN Capital started by Bill Dunn and currently owned by Martin Bergen. Our conversation today was pre-designed a little bit to talk about some of these trend following pioneers that have appeared on my podcast and have appeared on Niels' podcast. Without further delay, let's jump right into my conversation with Niels Kaastrup-Larsen. I've gotten on this hook of doing so many of these podcasts with non-trading guests just because it's fun and a lot of interesting people. And frankly, when you get into it, the whole mindset is almost the same philosophical trading process that we talk about. All these psychologists and economists, a lot of them come to the same understanding of, yeah, you got to take stabs at it. You got to give it a shot. You're going to get a lot of small losses. That's the only way you're going to find the big home run. It seems to all be the role of life, huh?
No, it's so true. And I also think, at the end of the day, with the amount of podcasts you've done, you have to spread out. And I also think that's why you have such a big audience, because frankly, when you stick to a small niche like I do, there is a limit to how many people want to listen every week. But I think what you've done is amazing. And I think that the people will take whatever they want to take from it. Sometimes it's a Nobel Prize winner, another time it's an author, or sometimes it's a trader. I think it's great. Is there a particular order to managers we're going to talk about today? I gave you kind of a list and I've kind of been thinking about them in that order, but is there in a particular order?
Oh, no, whatever I want to do, I want to make you uncomfortable, because then when you're uncomfortable, you might say something more interesting.
Oh my God.
If you're too organized and it's too in the list, whatever list you gave me, I have already stopped looking at it. I wrote something down in my handwriting scribble. So you are forced to go down the alley. But hey, before you go down that alley, before we start to kind of open up to some of these interesting names that people that follow both of our podcasts know all about, I want to stick with you for a second. You're a guy that's kind of like 30 years, approaching 30 years in the hedge fund space. Yeah, back to the late 80s.
Well, I actually started as a bond trader back in the mid 80s or late 87. 87 was when I got into this.
What month did you start at 87?
Well, it's funny enough. I think I started in September. And I think there's some truth to the fact that the early experiences, probably in whatever career, but certainly in finance, stays with you. Clearly, the events of October 87, I think, has made me somewhat of a cautious person when it comes to investing, even though it's funny because when people think of what we do, they think of it as being very risky, but I don't see it that way, of course. That was an interesting time. And then I think 91 was when I first got introduced to managed futures, trend following.
So 1991, you get introduced to, and I want to pick apart the name in a second, but for lack of a better term at this moment, 1991, you get introduced to managed futures trend following. How did that happen?
It really happens in the sense that I came from sort of the cash bond trading background, having done that and growing up and living in Denmark at the time. I was trading government bonds for one of the larger banks there. And what I saw back then was that all of the institutional investors, when they wanted to speculate, They were using cash bonds, but of course they were expensive and they were not super liquid, even though probably relatively liquid compared to many other things. What we did as market makers back then was every time we got hit with a large position from a client, we would hedge that in German Bund futures in London. We realized how liquid and how inexpensive they were to trade. I guess also I had an entrepreneurial gene inside of me. A colleague of mine broke out and started our own little firm, and we teamed up with the largest futures broker on the life exchange. Our sort of business plan, not very well thought out, but our business plan was really to go to Danish institutional investors and say, why don't you use the German Bund futures to do your speculation intraday or within a few days instead of Danish bonds? We made this agreement and we went around Denmark talking about the wonders of futures, the wonders of being in London and its cheapness and all of that. But of course, nobody wanted to move their money to London. Nobody wanted to trade futures. Futures had a really bad reputation back then. So in around 1991, I had to go back to a meeting to this firm, basically tell them that we weren't succeeding. We couldn't really move any business to them. Then they came up and said, listen, we understand it's difficult, but we have this little group in the corner down here, probably 25, 30 people in total. And they do something called managed futures, where you have a track record from managing money using futures. And maybe it would be easier for you to talk to investors about that. So you had something to show them. That's really how I got into managed futures. And of course, I had to study and read up on that and came across the turtles, and all of that really started back then. I've never looked back. I've never done anything other than managed futures and trend following. And you're right. I mean, that's been almost 30 years now.
Can you still recall the feeling that you had when you first understood what the Turtles, what AHL, what Richard Dennis, what Bill Dunn, what John Henry was doing? Can you still summon the feeling, that aha moment of what it felt like to see that for the first time? I just remember feeling, wow, this is clever.
Yeah, I'll say that it certainly took some time for me to fully realize and appreciate the value. Coming from a trading background, I was brought up by the understanding and philosophy that you should buy low and sell high. Once I started looking at what these guys were doing in terms of what trend following really is and how you define rules and how you buy breakouts and you sell breakdowns, so to speak, you're kind of asked to do the complete opposite. So it took me some time for sure to fully understand that this was better than buying low and selling high. But I think all the other aspects of what they were doing, and of course the returns that they produced, I mean, I think the best way often is just look at the evidence, like you did, I'm sure, when you looked at the track records. I mean, these were firms that delivered spectacular returns, not necessarily more risky than being invested in the stock market. And starting out in this kind of industry in September of 1987, then seeing the crash on October 19th, 1987, that certainly gave me some level of appreciation for risk and how risky these things were. Yet I was seeing returns that were significant, but it didn't seem to me that they were more risky. Then, of course, you start looking into, well, how can that be and what are they doing to minimize the risk yet unleash the upside potential? I think it was a process for me, Michael, to fully understand and appreciate that these guys were doing something different, but it made a lot of sense. And of course, once you then get into the nitty-gritty details and the appreciation of diversification, trading markets that are uncorrelated, and just the risk management and not relying on one single market or one single sector to do the heavy lifting for you, I think it all just fell in place. And as I said, I find what we do, and of course, being incredibly biased after all this time, but I find what we do makes just so much sense compared to a long-only strategy, which is also why it's frustrating to me why so few people still embrace the strategy and the concept, because what evidence do they have to support the idea that you shouldn't include it in your portfolio to some extent?
It's just controversial. That's the unfortunate word. I don't think it's controversial. You don't think it's controversial. I think the strategy has been positioned as that, probably by people that have other reasons for positioning it as controversial. Just to go back to where you were talking about those aha moments of seeing things early on, I still remember going down the path initially of seeing, okay, here are the turtles. I see what they're doing. That's interesting. Here's John Henry. I see what he's doing. That's interesting. And then I remember the first time I started to wrap my arms around DUNN Capital. I was like, what's this? Who is this? What's going on here? And then I'm like, hold on. They seem to be in the same headspace as these other guys that I'm looking at, but their returns even more dramatic on the upside. It was just an amazing feeling it was almost like being an investigative journalist. There was a film out a couple years ago called Spotlight that won a bunch of Oscars. I really felt like that when I was trying to piece this together because, look, somebody can go buy my trend following book now, or they can listen to your podcast and people can understand all these things. But back in the day, the people in the space weren't really talking a lot. It wasn't really something where there was a lot of insights you could find. It was more at conferences and in the back pages of a magazine, but there wasn't a tremendous amount of explanation. I just remember the whole process of uncovering how things fit together. Just for me personally, was exciting. It was interesting.
I mean, certainly in the early 90s, I think by then we had the MAR reports, and they were obviously trying to track the industry, and you saw the rankings and the league tables and all of that. And that gave you some flavor of this could be the beginning of some kind of industry, even though back then I think there were less than $10 billion under management totally. When I think back of what they were doing back in the 70s, where I'm pretty sure most of these pioneers, they did not know. Maybe they did, I don't know. But I mean, I don't think they had a lot of contact with each other. So I think they were really doing it on their own. An incredible, courageous decision and journey early on to apply new techniques to markets and not, as you say, not being able to find a lot of validation anywhere until much later. I find that's incredible.
They must have all, at least the common grandfather of many of the 1970s, 80s traders that we'll talk about today, the common grandfather would have been Richard Donchian. They must have all had some kind of, at some stage of the game, picking up an old copy of Commodities magazine in the 70s or early 80s and knowing about Donchian. I think that would have been maybe the common ancestor.
I think that's true. I definitely think they got their inspiration somewhere, and I think Donchian would be a good choice.
Here we are right there with that little nugget. We're talking about a particular style of a philosophy of trading that's going back decades and decades and decades. And I still get these emails from people and they'll say, hey, Mike, I read your book. It's really interesting. Or, hey, Mike, I listened to this podcast, or I listened to your podcast or this other podcast. It's really interesting. But Mike, I just saw a headline in Bloomberg and trend following is dead. It doesn't work anymore. What do you say, Mike?
Well, I mean, obviously, I see a lot of investors all over Europe and Asia. As you mentioned, I mean, we now have, at the end of this month, we have a 45-year track record. Yet people will still question, does this really work?
45 years. I mean, come on, 45 years. How many track records? I don't know if you know the answer. I don't know the answer. But how many continuous track records exist in the world from a particular fund manager, continuous, that's over 45 years? Buffett? Dunn? Who else? Maybe Soros? I don't know.
Very few. And this is also why that I still to this day can be a little bit frustrated about why people don't accept the evidence. Yet on the other hand, they're willing to listen to people who they deep down know are just making an educated guess or a forecast about what they think is going to happen. And instead, you have the opportunity to invest with managers who really have delivered on their promise for all these years, all these decades. It's just interesting. And maybe that's just how we humans are deep down, not willing to accept something that is uncomfortable. As you say, I mean, it's an uncomfortable strategy to be invested in. But over time, it's still a lot better than an 8% average return in stock markets with 50% plus drawdowns.
So look, everyone in the trend following world, they're going to have their own version of the special sauce. They're going to have their flavor of how they do it. And everyone's going to feel like their flavor's the best. That's just human nature. That's how it works. But if we stay at the big picture, philosophical view for a second, the big picture of trend following, looking down, how does it make you feel sometimes when you've been in the space for so long, some of the, what I would call inconsistent statements? Because we can go look at data, like performance data. We can look at all kinds of data. We can look at statements. We can look at other pieces of research across untold numbers of managers and traders going back literally decades. So much information. This is what I love to try and put into my book, Trend Following. But then you do get these inconsistent statements. And sometimes, look, the inconsistent statements come from people that are trading an entirely different way. sometimes those inconsistent statements come from people trading the same way. It can be confusing for the average person out there, can it?
I think it can. I think that's a great point, actually. And I think that this phrase that we hear from time to time, this time is different, is, I think, at the root of many of these things, because people want to believe that somehow markets have changed to a point where strategies that have been around for a long time shouldn't really work anymore. I think that they forget that markets, at the end of the day, is some kind of result of how we humans behave. And I know that a lot of people say, oh yeah, trend following is based on human behavior, et cetera, et cetera. But that's how markets work. We have periods of time where investors on both sides, some people prefer to be selling at a certain level and some people prefer to buying at the same level, and markets are relatively calm, et cetera, et cetera. Then from time to time, we get new information that pushes more people to be buyers than sellers. And we get these shifts in price or momentum or trends, as however people want to phrase it. And that creates these opportunities. It would be very weird if suddenly that behavior would stop. Why would we always interpret information to a point where markets would be in balance? We wouldn't. There's no evidence of that. But I do think we've made it a little bit difficult for ourselves to promote trend following as a strategy. I mean, on one side, we're very honest by saying that it's a hard strategy to own, because it is. So I think that's fine to be transparent about that. But I also think that we've always said that trend following is not difficult to do. It's relatively simple, and we use these words. And I think we have done ourselves a disservice by using that kind of narrative around the strategy. If I look at how trend following was done 20, 30, 40 years ago, and I look at how we do it on our side today, I mean, there's a world of difference. It's much more sophisticated in how we apply the techniques. The basic rules might still be simple. Putting them together is not simple, and it's certainly not easy. On top of that, you have all the implementation and so on and so forth, and the challenges that present. I'm not saying that we as an industry are not at fault. I think we can take some of the responsibility, but I just think deep down that this human nature always want to question things and always want to make it sound like that markets have changed. I remember distinctly that there was these articles earlier this year in February, just after the last kind of major drawdown for the industry. It's often Bloomberg that for some reason reports these stories, but they were out saying that because of Donald Trump and the way he tweets and all of that, suddenly markets were moving too quickly for trend followers. And that happens at the time when we're having the beginning of one of the strongest performance periods ever. In fact, on our side, in terms of performance, through this 45-year period, only once have we had 8 months in a row with positive performance. This year, actually, we had 7 months in a row with positive performance. Again, look at the evidence. Why are you suggesting that Donald Trump's tweets makes it impossible for trend followers to make money? I just think it's silly, but people choose to print these stories every so often.
Well, let's keep it there for a second, because I think people sometimes don't think about the game inside the game. First off, these publications that we're talking about, whether it's Bloomberg or FT or whatever, this is all just clickbait. This is all just designed to get you to click, and they make money from you clicking. So if the headline says trend following is a strategy designed by aliens located in Zurich in an underground bunker, a lot of people are going to click on that and then send me an email. So it's absolutely true. And I think also too, I think sometimes we don't think about the authority. Like if I, back in the day, wanted to reach out to an authority on the subject of trend following, I could contact a Jerry Parker, I could contact a Bill Dunn, etc., a John Henry, these authorities that have been around. What people sometimes forget with all this media stuff, go click who the author is and go look at their bio. The bio is always listed. It's invariably a 26-year-old journalism student. And the 26-year-old journalism student supposedly knows what's going on. They could possibly know what's going on. The reality is when you click a little further, the last 10 articles they've written have nothing to do with anything. They're all unrelated. They're unconnected. It's literally just somebody writing copy to get you to click. And whether or not it's accurate or not, they don't care. And I think that's really tough for investors because it often looks very serious. Oh my gosh, it's a headline on Bloomberg. This must mean something. No, it doesn't.
I completely agree. And in fact, I've heard you mention that before. So I have from time to time looked up the people who write these stories, and it is absolutely true. I mean, often people who have very little experience with what we do, but have very strong opinions about it. But we can only do so much. And I think what you've done on your side, what we try to do on our side, is just to continue to tell the story and continue to showcase the evidence and perhaps talk about it and educate people in a slightly different way than what we've done before. I think we just have to continue the good cause, so to speak.
Let's do that with a story. Let's start with a story. I'm thinking of a name, Jerry Parker. I would argue right now that when it comes to participation on Twitter, participation as an experienced trend following trader, well over 30 years, one of the turtles, that Jerry probably takes the mantle right now as an active person giving insights literally many times a day on his Twitter feed, would probably take the lead, so to speak. Out of anybody involved in the trend following space, I would probably argue. If there's someone else, you'll have to let me know. What do you take from Jerry? What's the big inspiration you take from Jerry Parker?
Well, I mean, I'm fortunate enough that I have a long relationship with Jerry because I actually used to work for him back in the mid-90s. My time with him goes back quite a ways. It's so interesting because I completely agree with you that Jerry does a great job of educating people and making these points on social media. What's interesting about it is that back in the 90s, Jerry was much more introvert, much more protected person about sharing information because, of course, back then, there was a lot of mystery still around the turtles and the rules and all of that secret sauce. And yet today, you have someone who is incredibly generous in terms of sharing and helping not just investors, but also a lot of young traders. One of the most important things he does, of course, we try to do it on our weekly conversation as well, is I think he's trying to pass on in some ways what I think he took away from the Turtle Project as the most important thing to him. That was the mentorship he got from Richard Dennis. The fact that losing money is okay as long as you follow your system. You should be celebrated for following your rules. Even mediocre rules are better than intuition when it comes to trading. I mean, those key concepts, I think he's doing a great job in passing on. And I'm very fortunate to having seen it up close, but also having been able to just observe how he's continued to build his track record for so many years.
In full disclosure, when I was doing my Turtle Trader book, which came out in 2007, the lead up to that, the research project to that, I had spoken with Jerry in person times before that project went into motion. For the book, I could not get him to talk. I probably got about half the crowd to talk to me, and the other half of the crowd wanted to take me to court. It was kind of that kind of a thing. You're right. Jerry was more kind of silent but deadly. Now with Twitter, when I want to kind of go out on any particular day and I want to read something smart about trend following, somebody that has curated other smart people or somebody who is just laying down his thoughts, Jerry's thoughts, that's where I want to go on Twitter. I don't know another trend following trader that's participating as much as he is.
I agree. I mean, it's fantastic. I wish there were more. I mean, I think actually, interestingly enough, even though it's someone that I don't have any direct experience with, just the fact that Larry Hyde just published a book and I listened to your conversation with him, I think that's also really important. I think it's incredibly important that some of these pioneers, they leave some kind of legacy that we can all hold on to and be reminded about those early days, those early teachings that still apply and really are timeless. You're right. I mean, a lot of people chooses not to share a lot. In some ways, it also reminds me a little bit about not a trend follower, but actually Ray Dalio, because he was also, I think, very careful how he was interacting with the press until he get close to retirement. And since his retirement, wow, has he been a wealth of information, and it's been incredible. If people don't take advantage of some of this information, they're losing out.
So I'll share a real quick nugget since you brought up Larry. Maybe people will throw stones at me for this. I'm somewhat responsible for Larry's book coming out in 2019 versus 2013, because in 2012, Larry and I were talking about doing a co-writing of a book. And then yours truly, the guy talking to you right now, me, Mike, I decided, oh no, I think I'm going to take a sojourn to Asia. And so poor Larry got delayed, but I have a sneaky suspicion, and I've said this to him, I think he's probably much happier to have done the book as a solo project and not a co-author, because obviously his experience, his name, everything he's done should have been only authored by Larry Hite. Ultimately, that's what he delivered, and I think he did a great effort.
Yeah, no, absolutely. I haven't read the full book. It's obviously just come out. I listened to your conversation with him, and he's a class act. There's just so much great information in what he says. And also, it's just the way he says things. And I'm going to butcher this up a little bit, but I mean, one of the quotes he says is something along the lines that there is very little magic in trend following, but what it does is magical, or something along those lines. How great is that? It just catches the essence completely in just a few words.
Before I drop you into some other names, let me throw out a little bit of a question debate. I wrote these names down today. I still think this is going to be a forever ongoing issue, I guess, so to speak. Managed futures, CTA, quant, systematic trend following. What the heck? Why can't the name be decided on? Why is there a definitional issue with this style of trading?
I think that's a good point. It doesn't help. I think some of it, as we all know, is based on how the regulators classified the strategy. That's how the CTA definition came from. I know people like Jerry likes the CTA. I mean, it tells people what we do. A commodity trading advisor, that's what we do. It's confusing, but I think we'll just have to live with it. Funnily enough, I remember back in the 90s, early 90s, around 94, which was a tough year for the CTA and trend following crowd. A lot of managers started just to call themselves a hedge fund. They thought that was better and that was more kind of acceptable by investors. But then, of course, later on, they kind of went back and took on the CTA managed futures classification again. I don't know what the answer is, Mike, but it's certainly something that seems to be confusing to many people.
Yeah, it's one of those things, just throwing it in there in the middle of this conversation. Let me go to one of the 1970s grandfathers of trend following. And you mentioned Jerry Parker. You mentioned his mentorship and Richard Dennis. I have found over the years, I'm probably the only person that has this. Literally any place and every place he has ever been quoted, I have probably got a copy of it. And I have to tell you, you talk about the statement that Larry made. I mean, Richard Dennis, right there in the same headspace. Literally just every potential interview he had in the 70s, 80s, 90s, it was just these 1-2 line parables where you just are taking a very complicated subject and bringing it down to a way where everyone could understand. Maybe everyone didn't understand it, but I think a lot of people did. I love him for that. I just really think when you go back and you look at his public statements over the years, very consistent, very eye-opening. Just, I seriously doubt, for me at least, I would much rather go back and find everything that Richard Dennis has said, if I had to make a comparison, than Ray Dalio. I find that Dennis's way of thinking is just a beautiful way of thinking.
Well, I mean, it's certainly simplicity at its core. And I think the way they talk, the way they describe these things is also the way they think about how to trade the markets. I think one of the strengths of sort of trend following approach is that we try to make things as simple as possible, not too simple. And this comes from behavioral finance, which I'm sure you know much more about than I do from all the people you've talked to. But I think it's been proven in many, many times that complex problems needs a simple solution. And there's very few things that are more complex than the financial markets and how they interact on a daily basis. In a sense, I'm not surprised that that's where we find the robust solutions, that they are somewhat simple. Even though I said earlier today that I think the way we apply trend following today is more sophisticated, the basic rules are still relatively simple. And I think Richard Dennis is a master of that also in the way he expresses himself about trend following, like some of the other great traders out there. So I agree with you. I'm envious to the fact that you have all that great information. Hopefully it won't go to waste. What he did back then is super important, not only in terms of sharing his information with the group of 20 were turtles, but also because it created this narrative, this story that I think our industry to some extent is lacking. And also through your books, of course, a lot of people know about the turtle experiment back then, even though it, in his words, was something that came relatively coincidental. One day he was thinking about it at the same time as he was drinking some Johnny Walker Black. That's how he thought it up. The way when I talked to him, he basically said, I knew that I was using 2/3 kind of rules in my trading and maybe 1/3 was intuition. He was just curious to find out whether It could all be rules-based and whether he could prove it. Nothing grand as such. And he just went on to do that through the experiment, keeping it pretty simple.
As a side tangent, there's some brilliant marketing things there that maybe he would not take credit for. Maybe deep down, he actually was the bright enough guy to set it all in motion. But when you look at the mystery and the word turtle and how that famous Wall Street Journal article unfolded, it's got to be one of the top 5 most famous Wall Street stories. Name the others. I mean, I guess because you've had The Big Short and The Wolf of Wall Street, those are famous now. But I would think among people that know about trading and whatnot, the turtle story is just right up there.
Absolutely. Actually, to that point, I mean, he came across to me as an incredibly humble man, not looking for fame in any way, unlike many other people who are associated with Wall Street. Yeah, I mean, I just think there's a lot of great things to be said about him, and we should be grateful for having someone like that do what he did.
Let me take you to something that's near and dear to you personally right now. You have a bias to this, and I will set it up. It's a fun setup. I don't know, gosh, what year would this have been? Probably 1983, 1984. I was 16 years old. I was playing baseball. I had a coach. My coach's name was Marty. And Marty is the guy who owns and runs DUNN Capital today. Now, what a crazy story that is. What a crazy story. How awesome. Started by Bill Dunn, being run by Marty now. Just an amazing, crazy confluence of events to see that happen. Why don't you give, maybe starting with Bill and then merging into Marty, why don't you share a couple experiences or thoughts? You know, I'm fishing here because I know a lot of things. I'm fishing for something perhaps new and unique that I don't know. You've got the stage.
I would say if we start by Bill, I mean, there's a lot of commonalities to Bill and some of the other great legends from back then. I think they all had certain things in common. As I mentioned earlier, I think they all had a lot of courage to do what they did. They obviously had commitment and a lot of consistency in how they wanted to apply and very, very clear thinking about what they were trying to achieve, and certainly not shy from implementing this with conviction. I mean, once they felt comfortable that they would never go out of business, even if they had volatile returns, they kind of stuck with that. But then at the same time, I would say that maybe some things that are not so often described about these people when you come close to them is that there's a lot of humbleness as well. It can be humbleness to the outside world, but it certainly also was humbleness to the markets, knowing that they would be from time to time taught lessons, and that's why they all diversified their investments quite a lot. It's a mix of different characteristics. I think a lot of the legends, including Bill, shared that. Some of the things, I'm sure you've talked about that in the past, that you would never sense on someone like Bill Dunn, or whether it was an up 10% day or a down 10% day. There was just no emotional association with kind of the daily or the monthly performance swings. And I think that that is so hard to do. It shows you a lot about the character when you meet people who can do that. Because we also have to remember that back when they started out, there was a lot less computer power. There was a lot less comfort you could get from sophisticated back tests and so on and so forth. But I mean, Bill and his son Daniel, who Daniel is still with our firm today, I mean, they literally started out going to the libraries every day. They had one of these punch machines that they could queue up their run, so to speak. They would come back giving them the buys and the sell calculations for the day. And I think it was not until the late 70s that they got a computer. And of course, this was massive size in terms of volume. They did finally in the late 70s get a computer to the office, so to speak. But in the beginning, it was going down to the library every single day. Bill created an enormously important and valuable platform and track record that Marty essentially has done an amazing job in taking forward. Because I think with Bill, you had the virtues of discipline and being very fair to clients. And you talk about how we have this unusual fee structure from time to time where literally we only charge our clients when they make money. So that's unusual. And that was something that Bill instilled back in 1974. He's kept the focus on trend following, not swayed away from that, even though a lot of sort of our peers have moved in different directions. There's no wrong or right, but I think that's something that makes it a little bit different. What Marty has done, and I know you have a long history, and I think it just shows you how small the world can be. What Marty has done is an amazing job in taking those traditions, keeping them, but then at the same time, creating an environment where people can innovate and they can improve, which means that what we do today is, as I said, it's a bit more sophisticated. We have more of a statistical approach to trend following. Being on this quest for quite a while now, since Marty took over, trying to deliver trend following in a package that more investors would be willing to take into their portfolio, because we know that it's such a hard strategy to hold on to. So if we can deliver that with a slightly higher risk-adjusted profile, then that's a good thing, as long as we keep all the goodness that trend following offers. These are just some of the things that I can think of when you bring that up. One thing that actually stays really clear for me is just a quote that Bill would always say in the office, and that is that the best time to invest in trend following is at the bottom of a drawdown. The second best time is today. I think that just kind of puts it very simple, just like Larry Hite has some great things, but I think this is also pretty timeless in terms of how you should view the strategies. Another legend for sure, and Marty, as I said, doing a great job in keeping that tradition going forward, but also allowing us to innovate and improve what we're doing.
To clarify, since I don't think I said last name, Marty, which would be Martin Bergen, the head of DUNN Capital today. I think one interesting little side tangent too, since I've already talked about Jerry Parker, that Marty and Jerry both having the accounting background. For anybody in the audience out there that is thinking that the Wolf of Wall Street is the archetype for how one makes money, then you might need to reassess when we're talking about Marty Bergen, we're talking about Jerry Parker, two guys with accounting backgrounds. I know that if you sit down in their office with either of these men, they are not going to give off anything remotely close to DiCaprio in The Wolf of Wall Street. And I think for a lot of people, that's still hard to believe, because that DiCaprio imagery is what many people do think of as what you need to make money on Wall Street, whereas the people we're talking about don't do anything like that.
Yeah, and I remember actually early on when I read one of your earliest books, I think you, at some point, you referenced the fact that your first visit to Dunn's offices was this weird moment where you come in and it kind of feels like being in an accountant's office. And actually, I think that's true. I mean, through all the firms that I've worked with, it's kind of the same feeling that you get when you go into these. And you're right. I mean, it's just very different to what people think and see on television and movies. It's a very well-organized process, and that's what it is. It's a process. It's not, we try to take all the emotions out by following strict rules, strict processes. That's why we can be more calm and collected, even if the markets are volatile every day.
So here's another name for you, another name of a firm and some individuals. So there was a little firm back in the day called AHL, Martin Luke, David Harding, Mike Adam. This firm went on to have quite success, and then David Harding, Martin Luke, they both branched off to start their own shops. Aspect with Martin, Winton with David. They both had quite great success, and they both have been absolutely pioneers in the trend following space. I'm thankful to both of them for being very direct and candid and straightforward in every conversation I've ever had with either of them. I've thoroughly enjoyed it. I still remember a conversation that I had. My gosh, it was approaching 15 years ago, the first time having a conversation with David Harding in his office, and just so remarkably blunt and direct. It is kind of interesting, though, that right now in this day and age, there's a little bit of controversy that these two pioneers that were kind of side by side for a long time have both gone on to make bloody fortunes in the trend following space. What do you think about that little bit of controversy there, Niels?
These three people are amazing individuals. And like you, most of my own conversations on my podcast is done remotely. But when I had to interview Michael, David, and Marty for their 30th anniversary, we decided to do it in person, actually at Abbey Road Studio. So in a small audio setting. So of course, it was very interesting just to observe the chemistry between these three people, where on one side, you could say they have long history together, but they also have a long history of kind of competing a little bit against each other. I learned a lot from that 2.5 hours for sure. First of all, I would say that regarding that little sort of debate we have going on right now, I think trend following can be done up to a certain size. I think once you get past, and I don't know what the number is, once you get into the double-digit billions of dollars, I think you lose some ability to take the best out of trend following. What I mean by that is that you have to slow your systems down, not to get too much trading cost. Maybe the most important thing is you lose a lot of the commodity markets because they're too small. So you lose the diversification benefit. I think the fact that maybe David has found, because of his success in building Winton into what it is today, I think that his experience is that, okay, maybe there are other things I can be doing that yields me a better return than just trend following. When you look at it that way, he's probably right that in his situation, just doing $20 billion or $25 billion worth of trend following probably doesn't yield him the returns that he and his investors are looking for. If you have someone like an Aspect or a DUNN or a Chesapeake, et cetera, we have no issues like that because our size is very different. So I don't think David is really saying that trend following doesn't work. I think he's saying that there are other things that he can maybe get to work better for what he's trying to do. And also question him actually a little bit about the whole concept of lowering his volatility. His explanation was that he didn't want to experience an October 1987 for his clients, even though, of course, we know that in a diversified portfolio, equities is just one small part of that. Who's to say that just because equities have a really bad run, that that's a bad thing for trend following? I don't think it is. What I found from sitting down with them is certainly that David is quite risk averse, it seems to me. Whether he was like that in the early days, I don't know. But I think that's part of the reason why. And also, I think his agenda is different. I think he wants to compete with a different set of peer group than the people we compete with and associate with. If you want to compete with the Rentex of the world and all of that, yeah, I mean, you probably can't have too much volatility in your returns, and you need a lot of different strategies, a lot of different markets to trade in order to manage 30, 40, 50 billion or however much he's looking. The three of them, you learn a lot just listening to their stories. Some of the topics that I found fascinating is also that even after so many years, you can feel they're still hungry for learning. They're still hungry for improving, which is actually, I would say, something that I sense on all of these people that we've talked about today. This quest for continuous improvement, I think, is very clear. Never rest on your laurels. There has been a few managers, though, that I've interviewed, and you know them as well as I do, who don't seem to have changed their strategy much in the last 20, 30 years. And where you can see that their returns, although they're good in the long run, they're just more volatile. It caters to a different audience, I would say. I think it's fine that there is a bit of debate, but of course the journalists are having a field day, because the unfortunate thing about Harding de-emphasizing trend in his portfolio is that a lot of people take that as a sign of trend following not working. Back to this point that we talked about earlier. I mean, these stories that for whatever reason, suddenly trend following has stopped working. When they see someone like a David Harding make comments that could be interpreted that way, they have a field day, unfortunately.
To add just some specifics to some of these numbers, you've kind of already said this, but I guess in the last decade, David Harding's funds under management has often been around 30 billion. Maybe it's dropped some now. And then the other large trend following traders, maybe 1 or 2 billion. You are very correctly pointing out that investors need to look at this with a wide set of eyeglasses on to understand what's going on. Because if you have one trader who has 30 billion under management and you have one trader who has 1 billion under management, that's a very different game.
Yeah. The problem is that investors often want the big names. And I actually think that in the last, say, roughly 20 years, we've certainly seen a lot more institutional participation in the industry. What that has caused is that everyone kind of seems to say, okay, well, in order to get these type of investors in, we should lower our volatility. The whole industry has delevered their returns, which makes it look like it's not working as well. That's by design. It's not because trend following doesn't work. I mean, on our side, we've actually seen the opposite. Our returns the last 6 years are stronger, better than they have been in the last 35 years. There's absolutely no evidence, in my opinion, that trend following as a strategy doesn't work. The industry has delevered to attract more institutional investors. There is this quest, it would seem, that people just want to look average, even though I think that's the worst thing you can strive for is average. There's a lot of reluctance to take risk, which is another thing, actually, just going off a tangent a little bit here. We mentioned earlier on a little bit about conviction and how actually even within our own industry, we've seen certain managers come out and talk about how trend following doesn't work so well because we have been relying on interest rates as the big return driver in the last 35 years. And it is true that trend following as a strategy has made a lot of money from being long bonds for a long period of time. To me, that's just because the strategy is designed to have conviction where the trends are. It says nothing about where the trends and the best returns will be in the next 30 years. There are many headways and there are many ways people trying to undermine the value of the strategy. But I think often it is based on their own, essentially talking their own book when they bring up topics like that. Anyway, that was a little bit of a detour, but
what's interesting when you talk about the wanting to be average, this is a really interesting point. And since we've been talking a little bit of DUNN Capital today, I can still recall the first time meeting Bill Dunn. One of the most intimidating handshakes that I've ever had. In fact, I can't name one more intimidating. Not because he was a mean guy or anything like that. It was because I knew what he had achieved and it was impressive. And to see that achievement and to understand it, to start to see how it was put together and to realize he did it and he did it well before the internet ever hit, to really be on an island, to pull this off. It was just amazing. Now, of course, he had an iron grip and he was a former Marine, so there was other intimidating factors as well. When you meet a guy like that, prime time, when he's tearing it up, you walk away inspired. You don't walk away from meeting Bill Dunn in his prime and go, oh yeah, I want to go back and get the T rate. What's my money market account doing? You walk away from that first meeting with Bill Dunn going, shit, I could do anything. He did it. He's inspired me. I mean, that's the attitude you take from those people. And I think for the many people that have been involved in the space that have helped shape it, that go for the juggler mindset, which does not mean some kind of high risk mentality, doesn't mean that people are trying to go broke by any stretch of the imagination. But with this particular style of strategy, you will get volatile returns if you are doing it a certain way that the pioneers set in motion. You're right that when you point out now, when so many institutional investors, which I don't want to say something negative about people that work for the government, you can use your imagination, the game changes a little because you're not dealing with the same mindset. You're dealing with people that are beyond average. They're polyester average. These are the kinds of things that investors need to really take into account. Again, back to the headlines. You got to do a little homework because not all things are created equal. You got to look under the hood and you can't just accept blindly what some 26-year-old journalism student is spouting off on Bloomberg or FT. Is that enough of a rant?
When you go in and you meet investors, there's definitely this fear that if they allocate too much to one asset class or too little, that they will look different from the average. So there's a very strong force about just being in line with everyone else, which of course is not what we're trying to do as individual firms. I see a lot of that really from an investor's point of view, which of course is a shame, but also going back to this thing about investors not to take on the volatility of the strategy and so on and so forth. It reminds me actually of a conversation with another, I would definitely call him a legend, even though he's not nearly as well known as some of the other people we've talked about, but that's Bill Dries. And Bill Dries started his trading back in 1976. I don't think he has a continuous track record exactly like that since then, but he's been around for a long time. And I remember from that conversation, he was talking about how a lot of the strategies that people seek in order to give investors this smooth return, they just end up warehousing risk until one point, like we saw with long-term capital, it all blows up. What we as trend followers are doing, we are recognizing the risk every day.
Real-time recognizing of risk.
Exactly. Yeah. We're realizing it on an ongoing basis. So it's a completely different way. I mean, I'm sure in your conversation also, a lot of people express that people like private equity. Private equity is sort of one of those strategies that at least for a long period of time where you didn't have to market your positions and you could kind of create this false impression that it was a very safe type of investment with very little volatility.
Can I pause you for a second there? You're making a great point because people want to look at private equity. They want to think about venture capital. And nobody has any idea what's going on behind the scenes. You talk about opaque, you talk about mysterious, you talk about not marked to the market. It's just one big Wizard of Oz behind the curtain.
Yeah. But the funny thing is, Mike, that there are also parts, certainly from venture capital, that you can transfer directly to what trend followers are doing, namely taking a lot of bets and waiting for the 5 winners of that year to pay for all the losers. It's funny how people tend to pick certain things that works for them. I mean, we know why. I mean, it's human behavior. It's how we are wired. So there's no surprise, but it's just interesting to observe how you can pick and choose whatever you feel best about, ignoring other parts of the evidence.
Nobody criticizes that I know of. Nobody criticizes the strategy of venture capital. Basically, lots of small losses, get your big home run, get your Google. No one criticizes that strategy openly as something bad or negative compared to trend following, where it's essentially the same mentality. Look, when you start the year off, guys at DUNN Capital, you don't know what's going to happen in terms of where the trend might appear from. You're going to take whatever's appears. And it's the exact same mentality. It is just really interesting that the same mentality gets praised on one side and criticized on the other.
Yeah. It's fascinating. It's fascinating.
Human nature, as you say. This other guy, too, who I find fascinating, there's some great NPR interviews and audio stories about it. This guy, Jason Blum, who does Blumhouse Productions, a Hollywood production firm, same mentality. He did the Paranormal Activity and a lot of these horror films. And he's basically saying, like, look, I'm going to allocate $1 million to each film, and I know 9 of them are going to fail, and one of them is going to make me $200 million. Boom. It's the same mentality.
Completely. And just going back to some of the things that came out of Larry's book, and of course, which goes to the root when you go back in history, and it all starts with cutting your losses. The winners will take care of themselves. But if you have the strength and the discipline to just make sure you don't let those losses run out of proportion, that in itself, it's a great first rule.
He really did name that on a conversation with me because he was getting all this advice from publishers about the titles, and these titles were long-winded, and he was getting frustrated. He goes, "The rule, that's it. It's the rule. I'm calling my book The Rule." I started laughing. I was like, okay, Larry, you call the publishers and tell them it's the rule.
Sure. But again, another example of just keeping things incredibly simple, which also kind of reminds me when I was sitting down with Alex Greaterman, of course, who worked with Larry for so many years, and how he told the story of his own disappointment when he had to go for an interview, and he was trying to find out from Larry what's the real edge of Mint, which was the firm at the time, knowing what you don't know. I mean, he was an academic expecting something really fancy. But I think if you ask Alex today about what really is the edge of trend following, it's exactly that, knowing what you don't know. That is not a very sexy story or interesting narrative to try and get across to investors compared to some kind of discretionary global macro manager who has a great thesis about why the dollar is going to go up or down. I mean, knowing what you don't know doesn't quite cut it, but it's so powerful.
These names that we've talked about today, people should go Google these names and find all of the podcast episodes across all the different podcasts that they have appeared on, because they just have got great insights, really. I mean, and Alex is another great mention. I apologize for not mentioning that further. He can kick me in the butt when he sees me next. He's fabulous. Hey, Niels, I've already kept you for a long time. Where can we send everybody? I want to send them to your podcast to check that out. Where would you like to direct folks to?
If people want to have kind of an introduction to trend following, I have a book that I co-wrote. They can get that for free. That's absolutely fine. They go to toptradersunplugged.com/Covel. Then there's a free download of the book.
/Covel. What kind of promotion is that? Oh my God. It's like tracking to find out, does anybody still listen to this guy Covel? Let's add the extension and see if anybody clicks. So terrible.
Absolutely. But I think I agree with you. Generally speaking, there's a lot of podcasts out there with great interviews, and some of them on my side, some of them on your side. And there's any resource really that helps people understand trend following better is a great place to start, without a doubt.
Niels, thanks for coming on. I enjoyed the chat. I hope I was not too fired up today.
Yeah, it was fine. It was fun. I appreciate the opportunity, Mike.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.